We've been carrying this e-commerce theme throughout the last hour. I pulled out a stat, $200 billion plus industry in the U.S. That's if you measure e-commerce as a group. And some analysts say, listen, this can even grow 15% going forward annually. Are you still a believer, or have all the good ideas been taken?
No, I would never, as a venture capitalist, you can never think that all the good ideas have been taken. So I'm definitely a believer in e-commerce as a category, and I think, the way I think about that is not betting against the future. And I think in the future, it's pretty clear that more and more people will spend more and more dollars, or a higher percentage of their dollars, online rather than off.
But are there kinks in the armor? I know with Fab.com, and this is a company that you got in early on, we saw that their fundraising was actually lower than what many in the investment community had expected. And some people said, look, that was partly the carryover, the negative carryover from Facebook's IPO. How do you see that?
So you mentioned Facebook. I do think that sort of the public market into the later stage private markets is one place where trickle-down economics does actually apply. And so when we thought about Fab, they took a very strategic approach to fundraising. Certainly they're nowhere near capital constrained. And I think, Jason and the leadership team over there figured out how to optimize the fundraising, given the environment, and they're setting themselves up to be a massive company in the future. Well,
to your point, they are certainly not capital constrained. I think it's probably the business that has raised the most money, at least here in the New York ecosystem, like $120 million. So to your point, they have the money that they need. But to what extent do they face, and not just Fab.com, but other companies like it, this kind of capital intense margin pressure? I mean, it's not easy to run businesses like this.
No, I mean, e-commerce is hard because you have a lot of moving parts. But I think ultimately e-commerce is actually a very simple business. So you need to make sure that your customer acquisition costs are lower than the lifetime value of that customer. And you can do things along the way to optimize that equation. And so when you look at Fab, and as you get to that scale and you're carrying inventory and you're doing a lot of things that add risk and add sort of capital needs to the business, what Fab has done is they've invested heavily in things like logistics and having their own warehouse. They've also invested heavily in building a brand. And so ultimately, they've recently announced that they're going to be doing Fab branded products. And obviously those come with higher margins and also a lot more flexibility. And the last point there is that they're not subject to the price pressures by Amazon and others, because you won't be able to find those goods anywhere but at Fab.com.
When you talk about building a brand, I know this is something that you've written about. You have your Sneakerhead VC blog, and you say every company should think about itself as a t-shirt, that there should be some kind of emotional connection for the consumer. How, if a company is able to pull this off, does it protect against fast followers?
So I think there's a couple things, but when you think about your brand and your company should be like a t-shirt, that comes from my background at Dan One. And what we found is that when we could resonate deeply with the consumer, they would talk about us. And this was back in 1998, and now when consumers talk about you, they do it at massive social scale. And so I think if you're building a brand that provides real utility to the consumer, the product you're offering provides real utility, those consumers are going to talk about you, they're going to tell their friends, and they're going to continue to be loyal shoppers. And so I think you really can extend your lead along, beyond the fast followers, given the sort of friction-free distribution you get with social.